Of late, we're seeing quite a few technology companies going public by listing their shares, but they've opted to do a direct listing and not an initial public offering. And a lot of folks have been asking us at Mr-Mak, what's a direct listing? Here's a quick and dirty on the advantages and disadvantages between going public via a direct listing versus doing it via an initial public offering. So direct listing simply means that the business will sell its shares directly to the public, and they do this without intermediaries like investment banks or underwriters. So on going public, they simply sell the shares directly to the public. Now, some of the advantages of a direct listing include the following. Firstly, you've got greatly reduced cost because you don't have to pay massive fees to investment banks and underwriters to facilitate the listing. It's also quicker and it's less onerous from a regulatory perspective. Thirdly, it allows early investors to enjoy a liquidity event. So there's generally no lock-in period for investors and they can sell their shares straight away. Now, because no new shares are being issued, there's also no dilution of the existing shareholders that takes place. These are some of the advantages of a direct listing. What are some of the disadvantages? Well, they include the fact that no cash is raised because the company doesn't issue new shares. Now, that's okay if the company is cash flush. So if you take a look at Slack, for instance, when they listed, they were cash flush. They didn't need any more money. Another disadvantage is the profile of the company in the minds of investors and the general public isn't raised because the marketing initiatives that take place in a traditional IPO don't happen. They don't occur. Last disadvantage of a direct listing is that the shares can flop on opening day because you don't have underwriters to prop up the price and guarantee it. However, if the investment banks who are helping with the direct listing do their job properly, they should ensure that the price at which the direct listing occurs is fairly accurate. So these are just some of the advantages and disadvantages of doing a direct listing rather than an IPO. So remember, with an IPO, the company will be able to raise additional capital, but they will pay large commissions and related fees, and these can range from 2 to 8%. They'll pay these to all the intermediaries, the investment bankers, the broker-dealers, the mutual funds, all the underwriters who facilitate the IPO. That's a big cost to the company, and it's a big cost to investors. And these are the reasons why some of the tech firms that we see today are opting for a direct listing as opposed to an initial public offering.